Hello and welcome to another episode of the Portfolio Fix, AAM's podcast series. This is our first episode of 2025 and one in which we'll share AAM's investment outlook for the year ahead. My name is Tim Senechalle. I'm the firm's Chief Investment Officer, and I am pleased to be joined by three colleagues from among our talented staff. Elizabeth Henderson, who leads our fixed income effort, Marco Bravo, a senior portfolio manager and the head of our investment strategy team, and Pete Wirtala, AAM's insurance strategist. We expect this recording, which follows last week's written version of our outlook, will last approximately 15 minutes. You can find this content and more at our website, www.aamcompany.com. Now let's start with a view on macroeconomic factors. Marco, as we start the year, economists are optimistic about underlying factors for the year ahead. That's different from prior years when there was seemingly a consensus that strong growth in the first half would lead kind of into slower growth on the back half of each of those years. What's different this year? What's driving that optimism?
Sure. Thanks, Tim. So we see two key drivers of the optimism this year. One, a U.S. consumer that continues to spend, and two, improved business sentiment that should lead to increased investment spending. On the consumer side, which has really been the main source of growth over the last couple of years, fundamentals remain healthy, and we continue to have a fairly strong labor market, both of which should be supportive for spending in 2025. On the business side, prospects for reduced regulations, lower taxes have definitely improved sentiment among business owners, especially small businesses, where sentiment recently reached its highest level since 2018. So continued strong consumer spending and improved business sentiment, two key drivers of growth for 2025.
And Marco, coming off of the fourth quarter of last year and the back half of last year when the Fed cut 100 basis points and expectations that we may get some here this year, where does that kind of strong backdrop leave the Fed? What's the next leg look like for us on this part of the cycle?
Well, our base case here at AAM is for the Fed to cut rates twice this year for a total of 50 basis points. What we view as kind of key data points, we have to recall that the Fed has a dual mandate: price stability and full employment. So key measures will be what's inflation doing, inflation expectations, and job growth will be the key data points that will drive policy. Our call for 50 basis points rate cuts is really predicated on a continued, albeit very modest, decline in inflation this year, and job growth that remains positive.
Gotcha. And then on maybe pivoting to the risk side, Marco, and there's, we talked about the clouds on the horizon. We hear policy proposals almost every day. Kind of how much are you and how much is the team paying attention to government policy issues like the debt ceiling and discussions there, Treasury issuance and technical factors, immigration and trade? Where does that weigh in as we think about the base case and the tails?
Yeah, for sure. Shifts in policy under the new Trump administration, complicating the outlook for both growth and inflation. So if we think about higher tariffs and tighter immigration policies, have the potential to be inflationary, and that introduces downside risk to our call for the Fed to cut rates 50 basis points. On the fiscal policy side, we think the main concern there is the prospects of continued large budget deficits. So lower taxes without an accompanying cut in spending could definitely spook bond investors, resulting in a demand for higher yields in order for investors to buy U.S. Treasuries. Higher yields, less Fed cuts, definitely presents downside risks to growth in 2025.
Thanks. And we've seen a little of that pricing in the last month or two with the curve steepening and tens settling in between 450 and 475 in recent sessions. Curious, what's the team thinking in terms of the trajectory of the 10-year as we move throughout the year? Where are we going to trade? Where might we end the year?
Yeah, I would frame it as modestly lower from current levels. We do think inflation will continue to trend lower, like I mentioned earlier, very modestly, and that should give the as long as inflation expectations remain well anchored, that should give the market comfort to bring rates lower. So our call is for 10-year yields to end the year in the 4.25% to 4.5% range.
Very good. So maybe some intermittent volatility, but a range bound longer end of the curve here. Appreciate that, Marco, and thanks for all the great work last year and as we move forward this year.
Thanks, Dan.
So let's turn to fixed income strategy and bring in Elizabeth Henderson. Elizabeth, Marco expressed cautious optimism for the kind of fundamental backdrop. Why don't you share with us what the team is thinking about the takeaways for public bond markets and fixed income performance as we move through the year?
So yes, our macro outlook is supported for risk taking broadly. We expect fundamentals to remain solid in 2025. Consumer and corporate balance sheets are in good shape. And then demand to remain strong for U.S. fixed income broadly. That said, we do have a mixed outlook for fixed income at a sector level, and that's due to valuation. So, for example, our outlook is for underperformance in corporate bonds. That includes high yield as well, given historically tight spreads to start the year with very little risk being reflected in those spreads. We do expect some more volatility, and Marco talked about sources of that potentially with changes ahead. So we do expect that to start to create more spread volatility and starting the year with very tight spreads, that there's just less cushion to absorb that. Conversely, in terms of potential sectors that could outperform, we see more of that potential in the structured products space. Those spreads are wider, so they do have more of the potential to absorb that volatility. Mortgages, asset backs, and commercial mortgages.
So, Elizabeth, you mentioned mortgages, and let's talk for a minute on the residential mortgage side. They've had a tough decade or so with the Fed having inflated prices going back to the various QE cycles. What's different now that kind of makes that sector and its performance potential prospectively better?
So government that intervention is largely over in terms of how it's affecting mortgages. But as we think about mortgages, we don't just look at them in an absolute, we look at them relative to other sectors. So thinking about corporate bonds as an alternative with those spreads starting the year at very tight levels, there's really just one way for them to go, and that's wider versus mortgages where spreads are for current coupon more in the midpoint of their historic range. So there's just more room for that compression. Second, our expectation is for modest rate volatility. Marco talked about that. And that's constructive for mortgages at these wider levels. And then lastly, which is an important component of mortgages and treasuries to some extent, is that if our forecast is wrong and growth is much weaker than expected, we'd expect a flight to quality trade, which is supportive for a risk-free type of sector for mortgages. We saw that actually last summer when that fear emerged. Corporate spreads widened about 20 basis points, as you remember, while current coupon mortgage spreads really didn't change. So it's a great sector at this point in terms of being more of a defensive play in the portfolio.
Thanks for that. And last year, the credit team did a great job picking sectors and securities that did enjoy that spread tightening. Sounds like there's less of that given where we are today on the horizon and better value, as you say, in structure and ABS and CMBS. What is it about those sectors? What's going to drive excess returns there that'll be improved against corporates going forward?
ABS is an easy one. When you think about the way fundamentals, technicals, and valuation line up, again, our constructive macro outlook and the solid consumer and corporate fundamentals, but that leads us to expect very little spread for credit risk, just like what we're seeing in the corporate bond sector. From a technical perspective, ABS is very similar to corporate bonds with demand outstripping supply there. So a very strong support for spreads. But then from a valuation perspective, that's where the difference is. ABS spreads are about 5 to 10 basis points wider where we would expect them to be given all of the drivers and looking at periods similar to this historically. So simply there is more value in that market versus, again, corporate bonds where you're starting at historically tight spreads.
Very good. And it sounds like we've got a good frame of reference for how the strategy will play out in the base case and in an environment where growth slows and rates rally. I'm just interested in your perspective on what a stress case that may lead to underperformance, or what are the risks that may lead to underperformance in the plan as we move ahead.
Two sources of that in terms of our outlook, and that is first, economic growth is much weaker than expected, and I'm talking more towards 0% versus the expectation to be around 2%. We've really been fortunate in terms of higher interest rates have not been as much of a drag on corporate earnings as many expected. And that's because of the very strong economic growth that we've had since COVID. So if that does change, then we'd expect default risk to start to go up, especially if we don't see interest rates falling, which could potentially happen if you have inflation being a concern like Marco talked about. So in that scenario, you would see risk-free or risk assets underperform. And then the second is just a much higher level of interest rate volatility than we're expecting. That affects both the technicals and fundamentals of various markets, especially those that are finance related. And of course, the catalyst for that rate movement is particularly important and instructive on how we'd expect sectors to perform. So that if that volatility was caused more by fundamental concerns, we'd again expect risk assets to underperform.
Thanks for that perspective, Elizabeth, and thanks for all the great work. Keep it up.
You bet.
Let's shift now to non-core assets and bring in Pete Wirtala, our insurance strategist, who can shed some light on what's happening in private markets and equity-oriented strategies. Pete, risk premiums, we've heard now from the team, public markets have tightened, those spreads are narrow, and at the same time, we've seen a lot of capital head in the direction of private segments, insurance companies kind of embracing this trend with the search for added yield and trading liquidity for that. Interested in your thoughts on how you assess and what the team is viewing the opportunity in traditional investment grade privates and in first lien commercial mortgage loans.
Sure, Tim. So I'd say there's certainly opportunities for those willing to take on liquidity risk, but it's important to be opportunistic about it. The generally healthy economic conditions that Marco was talking about have meant that defaults and downgrades to below IG have been rare, and that's especially important considering that a large chunk of the private placement market is rated BBB. 2024 was a strong year for private placement issuance, and it's looking like 2025 is going to be more of the same. But there's been no problem absorbing all this issuance since life insurers especially continue to have a lot of appetite for the sector. And as you mentioned, as with public corporates, credit spreads are now at the tighter end of the historical range, but there's still an illiquidity spread of privates over publics, and that remains fairly valued in our view. So really, if anything, there's an opportunity here for investors who become wary of investing in public IG credit, given those tight spreads you mentioned. Now, speaking of CMLs, the picture is a little more complicated. Fundamentals there vary a lot depending on the type of property you're talking about. Generally speaking, multifamily housing, the new data center properties that are starting to come online, and then the higher end of the retail segment are all areas that are facing stronger outlooks. On the other hand, industrial and then especially urban office properties are having a tougher environment right now. There's definitely a lot of demand still in that market, especially since yields are higher now than they've been in many years. But issuance has been declining. Borrowers there are looking into alternatives like floating rate debt or taking out shorter loans to try to bridge themselves over to a lower rate environment. So, bottom line with CMLs is there's definitely strong yields to be had, frequently over 6%, but you need to be choosy about sectors and recognize that there's some borrowers there that are facing a tough outlook if rates stay at these current levels for a while.
Thanks, Pete. Yeah, some of those themes roll over from the public securitized market in the CMBS space as well. Shorter tenors, some floating rate, and sector specific performance varying. So appreciate those thoughts. Let's turn to equities, Pete, and talk the higher risk parts of portfolios. For the past 5 years have been very strong for stock market investors. I think the S&P 500 up over 18% in 4 of those 5 years, with one down year among them. How are you thinking about short-term momentum versus long-term valuations?
All right. Well, for starters, I'd say that we definitely are watching those two things battling it out before our eyes every day here. It really is the old Benjamin Graham line where in the short term, the market's a voting machine and sentiment rules, and in the long term, it's a weighing machine and you need strong fundamentals to justify a high valuation. I mean, you're absolutely right. Momentum's been very strong lately. In 2024, the S&P 500 never fell below its 200-day moving average. In the last 35 years, there have only been 6 years where that happened. If we look since the COVID bottom in March 2020, so almost 5 years ago, the average annualized return since then is over 24%. And you think about how longer term people think of the average annual return on equities being kind of 7 to 10%, it tells you just how strong things have been. Really, it's harder to find any time it's been better to be invested in US equities from a momentum perspective. And the thing about strong sentiment is that it sort of becomes a self-fulfilling prophecy, at least until some new catalyst comes along and changes the narrative. But that being said, levels or valuation levels are now either at or only slightly below the highest level they've ever been. You look at price to revenue, price to book, and especially the total market cap compared to US GDP. These are these have all historically had significant correlations to the subsequent returns on the market, subsequent long-term returns. And by these measures, recent gains we've had now put the market at valuation levels well above where they were at the peak in 2000. The good news here is that the mega cap companies that have been particularly driving the market higher all do have extremely strong and profitable business models. So there is a fundamental case to be made. But the challenge is that ultimately nothing grows to the sky. And this latest wave of upside has in large part been both due to benign economic conditions, and presuming those will continue, and also on the LLM theme and the belief that that's going to become a business comparable to what smartphones are for Apple or cloud computing is for Amazon. Just yesterday, we saw Nvidia lose over $500 billion in market cap. It's by far the largest single day market cap loss ever in a single stock, just over one headline about a new AI model from China. And that really gives you a glimpse just how quickly things could turn around if the current bull thesis does hit a bumpy patch. So I'd say bottom line, in the long term, we are confident that US equities will continue to make sense as a core risk asset for insurers. We would slap a results not typical label on the performance of the last few years. And we recognize that current valuation levels do imply a greater degree of market fragility than we've seen in a long time.
So diversification and discipline rule here as well as in a fixed income world with tight spreads. Appreciate that, Pete. And maybe that serves as a segue for us to talk the more defensive strategy in the equity linked environment, the convertible bond market where we have been investors and clients have been investors for 30 plus years. How does the year ahead, how do the fundamentals in 2025 set up for this asset class?
Sure. So Fundamentally, converts continue to fill the role that they've been successfully filling for those 30 years, and that's capturing equity upside in market advances and then offering downside protection in the form of coupon income and return of principal during risk-off periods. Now, looking ahead into 2025, there's a few trends that we see for converts. A big one is that issuance is probably going to remain strong as it's been lately. This is important since the overall convertible market is not very large, and it has sometimes in the past gone through dry spells of sustained low issuance. So it's nice to have that no longer an issue, one could say, in the near term. The yield curve rose in the end of the year there, and borrowing costs are still pretty high for corporations, and many of them are now finding that converts offer a cheaper source of funds relative to just borrowing in the straight debt market. Now, in terms of their equity component, I mean, lately the market has been kind of bifurcated, where the high-flying mega cap names have been the strongest performers, and then everyone else has been chugging along separately from them. And it's true, the mega cap companies are not big issuers of convertible debt, and so the sector should not be viewed as a bet on specifically their performance, like you're seeing in maybe the Nasdaq. But on the other hand, if that sector runs into some headwinds, convertibles should be very well positioned to outperform and be more in line with smaller and mid cap equities who would be a bit more active in the space. And in particular, if we see deregulation being an important theme coming out of the new administration, that would be something that could be a particular boon to smaller companies, and we'd expect that to be positive for convertible underlyings as well. And then another theme here being that convertibles now have higher coupons than they've had in many years, and that makes the income component of their returns more material than we've seen. This is both, it's nice because it stabilizes the overall returns you're getting from the sector, and it helps give you that downside protection if equities should fall. During the low rate environment of a few years ago, it was not uncommon for converts to just have 0% coupons. So seeing that we've made a lot of progress there helps to keep the sector kind of doing what it should as a hybrid instrument that's giving you both that income and then total return upside as well. So in summary, it's a positive environment for converts going forward, with the one proviso that the sector isn't really designed to capture the upside of just the 4 or 5 biggest tech companies in the economy. But apart from that, there's still a lot of these other reasons why converts do look compelling in 2025.
And should be stated that that MicroStrategy is a big issuer and a big part of the market. So buyer beware and know thy issuers in the convert space if you're dipping your toe in that water. Pete, thanks a lot for the insights on equities, lesser liquid, non-public strategies, and converts. Appreciate that.
Thanks.
So that concludes our 2025 investment outlook. And over the past 15 minutes, you've heard our team describe our optimistic view, although some caution on the horizon with respect to fundamentals and the health of the economy, credit measures, and earnings growth. But all of that has to be weighed in the context of valuations, and those are lofty across most markets. And that ties into our 2025 outlook theme. The view is better up here. It really reflects this assessment of high prices and the opportunity that this market gives us to position portfolios to choose risks carefully, reduce them where we're not compensated for risks, and rotate portfolios. We are not avoiding risk, particularly within credit markets. We're picking sectors and securities that we believe will deliver excess return through some spread tightening and carry, but it costs us very little to rotate into other parts of the market that the team described as more attractively priced. Within equities, we've rebalanced our portfolios back to target, and as Pete indicated, if momentum shifts, we may move to an underweight position in that market, taking advantage of such strength over the last 4 or 5 years. For our portfolios, and for those that are return-oriented within the fixed income market, we like securitized. For those that are income-oriented, we like that securitized market as well, as illiquidity risk in privates and mortgage lending, although underwriting will be key in both of those spaces. With all of this tied together and a disciplined approach, we look forward to delivering on your investment objectives in the year ahead. And thank you for joining us today. Please stay tuned for future episodes of the Portfolio Fix. We were brief in our comments on non-core strategies, and in future episodes, we'll be joined by partners and experts in areas related to commercial mortgage lending and our recent partnership with Affinius Capital, Zazov Associates in convertible bonds, and their Chief Investment Officer, Gene Preddy, and Muzinich, with whom we partner in high yield and direct lending markets. And last but not least, our partners and affiliates at Securing Asset Management, with whom we invest in the private placement market, will join us as well. So thank you for joining us, and we'll stay invested. Thanks.